Everyone's talking about the Fed, Trump, and interest rates right now. A lot of headlines about Trump possibly taking over the Federal Reserve or making the Fed less independent. Some call this dangerous. Others think it could actually help the economy. But what does it actually mean for your mortgage, your money, and the economy? That's what we're breaking down today. To really understand what's at stake, first need to talk about what the Federal Reserve even is. It is a public institution with some unique structures designed to balance independence and accountability. The Board of Governors in Washington, D.C. is a federal government agency. Its members are appointed by the President and confirmed by the Senate. The 12 regional Federal Reserve banks are set up with some features of private corporations. The Fed is independent in its decision making, for example, setting interest rates. So, this is why President Trump has been trying to fire chair of the Federal Reserve, Jay Powell, but has failed. Trump was urging the Federal Reserve to cut interest rates by 3% down to 1.5%. So they did cut it. It was by 0.25%. They cut it from 4.5 to 4.25%. And what really got Trump upset is that at that meeting, the Federal Reserve released their updated projections. They're going to slowly cut interest rates and get it down to 3% to 3.25% by the end of 2028. So of course, Trump didn't like that. So President Trump has been trying to get rid of the voting members of the Federal Reserve so that he can get what he wants. You can agree or disagree with President Trump. So why Trump cares? Because lower interest rates mean cheaper borrowing, a stronger economy in the short run, and less money the government has to spend on debt payments. But big rate cuts risk reigniting inflation. After the Fed's first rate cut this year on September 17th, and expectations of 2 more by year end, where are mortgage rates headed? Rates are influenced by more than the federal funds rate. They reflect inflation. Higher inflation pushes lenders to raise rates. Bond market. Mortgage rates track 10-year Treasury yields. Rising yields typically mean higher rates. Unemployment. Low unemployment can increase housing demand and rates. High unemployment may lead to cuts. GDP growth. Strong growth boosts housing demand. Rising rates. The Fed versus Trump. Fed cut rates slightly, 4.5 to 4.25%, but forecasts a slow decline to 3% by 2028. Trump opposes this and is placing allies on the Fed, like Stephen Byron, who voted for larger cuts. When Powell's term ends in 2026, Trump is likely to appoint a more rate-friendly chair. Why this matters for you? The Fed chair has huge influence. Even if there are only one vote, most members usually follow the chair's lead. That means if Trump gets his way, we could see faster, deeper rate cuts and more money printing starting in 2026. What does that mean for us? Lower mortgage rates in the short term, but also higher inflation and more volatility down the road. The Constitution gives Congress the power over money. Our founding fathers like Jefferson and Madison actually warned us against central banks for this exact reason. They feared inflation and loss of liberty. The Fed has too much unchecked power, and their policies often widen the wealth gap. The rich benefit from rising asset prices, while the middle class and lower income families struggle with higher costs. Whether you agree with Trump's approach or not, the reality is this. If Trump reshapes the Fed, expect lower rates faster. That could push up home prices, stocks, and even accelerate inflation over the next 5 years. The key things to watch are inflation data, CPI and PCE reports, the Fed's main guide, job data, unemployment, payroll reports. If jobs slow, the Fed cuts rates. GDP growth, slower growth usually means more cuts. Bond yields and the 10-year Treasury, mortgage rates tend to follow this more closely than the Fed funds rate. Here's a quick chart idea I'll show in the video. On one line, the Fed funds rate, currently just above 4%. On another line, the average 30-year mortgage rate, still above 6 to 7%. The point here is that mortgage rates don't move in lockstep with the Fed. They're influenced more by long-term expectations, like inflation and treasury yields. So here's the bottom line. Trump wants lower rates. The Fed wants to move slower. And you and I are caught in the middle. Whether you're buying a home, investing, or just trying to understand the economy, keep your eyes on inflation and treasury yields because those will tell us more about where mortgage rates are headed than political drama. So, what do you think? Should Trump push the Fed for lower rates? Or should the Fed hold its ground? Drop your thoughts in the comments.